All right, let's get right into it. We're going to break down the absolutely dramatic story behind the trade desk's recent stock performance. I mean, this company was a Wall Street darling, and then, well, it faced a brutal collapse. So for investors, the big question is why? And maybe even more important, what happens now? So to really get to the bottom of this, we're going to tackle it in 6 parts. First, we'll look at just how big this fall was. Then we'll dissect the perfect storm that caused all the damage. We're going to dive into that major threat from Amazon, wrestle with the super tricky question of valuation, and then explore what a recovery in 2026 might even look like before we finally reach a verdict for investors. Okay, so first things first, we have to grasp the sheer scale of this fall from grace. The speed and the size of the stock's decline was a real shock, even for people who watch the market every single day. Get this. From its peak in late 2024, the stock didn't just dip. It absolutely cratered, wiping out a staggering 75% of its value. Now, to put that into perspective for you, the trade desk had this celebrated entry into the S&P 500 in 2025, right? By the end of that same year, it was the index's single worst performing stock. It's hard to overstate that kind of reversal. This massive drop really represents a huge reset in how Wall Street values the company. We're talking about a market cap that lost something like $47 billion in value. You know that old label it had, priced for perfection? Yeah, that's been completely torn to shreds. So what on earth caused this? This wasn't some slow, gradual decline. No, this was a collapse. And it was driven by what you can only really call a perfect storm of negative factors hitting all at once. So to answer that core question, why is the stock making new lows pretty much every day? It wasn't just one thing. It was this brutal combination of 4 major issues hitting the company simultaneously, creating this powerful downward spiral. Think of it like a 4-punch combination that just knocked the stock out. First, you had an executive stability crisis. Lots of turnover at the top created this feeling that the ship didn't have a steady hand at the helm. Second, the Amazon Netflix threat became very real. A huge partnership in connected TV suddenly made Amazon look like an even bigger competitor. Third, the growth story itself just hit a wall. The company missed its revenue guidance for the first time in 33 quarters. That's a legendary streak to break. And finally, you had these broad economic headwinds, with uncertainty forcing major advertisers to just slam the brakes on spending. And that instability at the top is so crucial. I mean, when a CFO leaves that abruptly after less than 6 months, it just creates so much uncertainty for investors who really, really rely on consistent, stable leadership to get through tough times. It's a massive red flag. Okay, let's zoom in on what many people think is the biggest long-term risk here, that Amazon-sized threat. This is really about the battle for the future of TV advertising, a market that, by the way, accounts for about half of the trade desk's entire business. Now, to really get this fight, you have to understand the battlefield. On one side, you've got what they call walled gardens. These are the closed ecosystems like what Amazon and Google have. And on the other side, you've got the open internet, which is where the trade desk has built its whole empire as the independent choice. And this just lays out the core conflict perfectly. The trade desk's entire pitch is its neutrality, right? It doesn't own the content, so it can be an objective partner. Amazon's power, though, comes from its incredible treasure trove of shopping data and its ability to prove that an ad you saw led directly to a purchase on its site. That is an unbelievably powerful competitive moat. But here's the counter-argument. A lot of analysts think the trade desk's business is far from being done. They argue its position as the biggest independent choice for the rest of the internet, the open internet, is still its most powerful defense. Let's be honest, a lot of brands are pretty nervous about putting all of their eggs in Amazon's basket. So after a 75% drop, the question every investor has to ask is this stock a bargain now? Or is it somehow still too expensive, even down at these levels? Let's dig into the numbers. And the answer to that multi-billion-dollar question is, well, it kind of depends on how you look at it. And this creates this really fascinating split of opinion among analysts who are all trying to figure out what the company is actually worth. So on one hand, you've got these models based on future cash flow. That's called DCF analysis. And one prominent model suggests the stock is deeply undervalued, with a fair price somewhere over $100 a share. But then, on the other hand, if you look at its price-to-earnings ratio, basically how much you're paying for each dollar of profit, it's still pretty darn high compared to others in the media industry. This chart really drives that point home.
Even after this huge crash, investors are still paying a big premium for every dollar of the trade desk's earnings compared to the rest of the industry. What that tells you is the market is still betting on a strong recovery, which leaves very little room for any more mistakes. So the big question? Are there any signs that the business is actually turning around? Well, despite all these intense headwinds, there are several major catalysts coming up in 2026 that could absolutely fuel a significant rebound for the stock.
There are three huge events to keep on your radar. First, the outcome of the Department of Justice's antitrust case against Google. This could be a once-in-a-generation opportunity for the trade desk. Second, the adoption of its new AI-powered platforms, Kukai and Ventura. If those take off, it could prove their tech is still the best in the business. And third, you've got the massive wave of political ad spending that comes with the midterms, which could be a huge boost to revenue.
The company's CEO, Jeff Grain, even admits that it's a tough environment for some big brands, but he believes the whole market is shifting towards data-driven, independent platforms just like theirs. He thinks it's creating a buyer's market where publishers actually need the trade desk now more than ever. Okay, so let's pull all of this together. Is this a moment to buy, or is this a huge warning sign telling you to stay away? Let's lay out the final verdict by weighing the bull case against the bear case.
The bull case goes something like this. You have a highly profitable, debt-free company that's the clear leader of the open internet. Some models say its stock is deeply undervalued, and it's got these potentially huge regulatory tailwinds coming its way. The bear case? That executive instability, the intense competition from Amazon, and slowing growth, all combined with that premium price tag, make the stock just way too risky right now. So if you're trying to make an informed decision, these are the things you absolutely have to watch. The next earnings report in February is going to be critical. But just as important is seeing if they can finally stabilize that leadership team, prove their new tech actually works, and of course, capitalize on whatever happens in that landmark Google case. And this all leaves us with the ultimate question for investors today. Does this historic, painful collapse represent a rare, maybe even generational opportunity to buy a category leader at a massive discount? Or is it a classic value trap just warning you that there's more trouble to come? That's the multi-billion-dollar question every investor now has to answer for themselves.